Good evening, everyone. This is myself. We are taking a quick look at the portfolio. So, as you guys know, I am looking to prove that triple leverage ETFs are not as bad as people say. Now, as I've explained previously, my portfolio is a bit of a mess. You'll see some options in here. You'll see quite a bit of the positions all ETFs, all ETFs in here. I don't hold any individual positions, only ETFs. And I wanted to go over quickly about the worst part of leverage ETF owning. So I'm going to show you guys a little back test here, okay? Now I haven't even double checked this. Wait, hold on. They're making me update. Be serious. Okay. Ooh, 1986. Okay. Anyway, so we're gonna go 1, 1, 2. I'll just go 2000 actually, and then 01, 2010. We'll go 10 years, right? I'm just gonna do. Uh, let's just start at 10,000 actually. Let's just show you what the problem is. I'm gonna do two portfolios: SPY, Lev. Okay, and we're gonna do a little SPY sim. This is a portfolio um back tester, so it allows you to test some things. So this is regular SPY, regular the S&P 500. And then we have it leveraged X3. Am I stupid? I am stupid. Okay, good. 100%. I'm not gonna mess with the rebalancing. Here's the issue, and this is a really bad time to invest. So let's say you invested between 2000 and 2010. You get hit with two huge macro events. All right, and you'll see the loser is the SPY Lev by a ton. Now, there's no dollar cost averaging in here, and I think any smart investor should be putting more money into the fund as you go in. Look at this. You start at the beginning of 2000, and then you go to 2010, and look at this destruction you get on your portfolio. I mean, you get negative 92% return. You start at 10,000, you end at $700. You lost 99% of your money, right? Or 93% of your money. Um, so this a lot of people call this the lost decade when it comes to stocks. And you'll notice if you just invest $10,000 at the beginning of 2000, you end it with actually less money than you did in 2010. And this is actually pretty rare. There's very few 10-year rolling windows where the S&P lost money. And I believe there are zero 20-year rolling windows where the S&P lost money. Now, that's not a huge deal. Or rather, that is a huge deal. It's not a huge deal if you're a regular investor, right? So if you're an investor for the long run and there is a lost decade, it's not brutal because I'll show you this. 2010 to 2020, this is right before COVID. So sure, you had a lost decade, but then it was preceded or superseded by the strongest decade that we've really ever had with stocks. Now, it's hard to see this bar next to the leverage one, right? The leverage one outperforms by so much that it's literally hard to even see the movement on the regular S&P. But we can take off the leverage for a minute. Now, just to show you so you can see the movements. But if you're in it for the long term, these lost decades are not a big deal. Here, I'll even go back to 2000. We'll just say 2000. Back test. If you're a long-term investor, the line goes upwards to the right, right? It always goes upwards to the right, generally speaking, over long periods of time. I gotta double check my math, and even this is like considered a bad return, 6% compared to the typical like 8 to 12 it typically returns. But even with a horrendous decade, and even with no dollar cost averaging, you still are on the up, right? You get a 3x on your money. Um, so that's the great thing about SPY is diversified. The S&P is diversified. The other way you can diversify though is with time. And what I mean by that is instead of investing $10,000 at one point, kind of timing the market, because you see in these. I think it's better to show. Let me show you again the the leveraged 2000 to 2010. Okay, 2000 to 2010. Look at this. Like I said, you lost almost all your money. Almost all your money, right? But let me show you one way you'll lose less money on the leveraged and also on SPY. So let's say they're on a down year, a down decade. You can diversify with time. Instead of doing $10,000 straight up, what if I did $1,000 every year? Oh, hold on, sorry. I'll start at $1. Bear in mind there's a $1 drift on this. Let's say I did $1,000 every year. Okay, this is called diversifying with time, and you'll see, wow, SPY triple leveraged does like a 4x compared to what it is if you invest it all here. Now you'll see obviously a lot of the money is being entered later. And dollar cost averaging, investing consistently over periods of time. You could change it to like monthly, you could do like 100, what's we'll call it like $85 a month, right? That's like 1,000 divided by, I'm not the best at math. What's 1,000 divided by oop. What's 1,000 divided by 12? It's like 85, right? You could do monthly, you might even look better, it might look worse, let's see. It looks a little better for SPY. It's actually SPY end up positive. Huh. Um, but you see diversifying over time protects you in the downturns, right? Dollar cost averaging protects you in the downturns. It doesn't really help you in the upturn. So if I change this back, right? If we go to zero cash flows and we go back to the 10,000, right? I'll just show you those numbers real quick. From 2010 to 2020, just a bull decade where the stocks just went straight up, right? If we go back to this is with no dollar cost averaging, 169 on the leverage, 35 on the regular. Incredible returns. Now if we start changing that to that 1,000 a year, you'll actually notice lower returns, right? You'll notice you only get 20 on the 21 on the SPY for dollar cost averaging and 70 on the leverage portfolio. So dollar cost averaging protects you from a risk, and that risk is timing the market. The risk is a sequence of returns, right? If you enter in a bad time, it hurts you a lot. So dollar cost averaging protects you from the negative effects of both regular investing and leverage, but it actually hurts your upside. Something to keep in mind. So that's one way I diversify. It's by adding money in slowly over time. Instead of dumping a lot of money in at once, to protect my downside, I go in slowly. Now I'm super slow. My positions, it's actually better to look at the spreadsheet. My positions are not high. Okay? My positions are not high. Look at this. I have about $150 of for my strategy. Now remember, my strategy is 60% UPRO, that's the triple leveraged S&P, 20% gold, 20% bonds. Rebalance quarterly. I'm not rebalancing this quarter because I started in March. So I'm going to let this grow for a little bit. I have some other numbers around here because there's a lot of other nonsense I'm doing. Now you'll notice I have the triple leveraged NASDAQ, which, as if you're a triple leverage investor, you know it's done horribly in the last couple of weeks with the oil Strait of Hormuz nonsense, but whatever. I want to move from TQQQ to UPRO and to these other things, to these diversifiers. Um, More of the story is, so you can diversify with time, but as I've told you, you can diversify with other assets, and that's why I hold gold and bonds. Why do I hold gold and bonds as diversifiers? Great question. Let's go to here actually. Let's go to here. Let's go to I'm once again, this is not even something I've tested. We're gonna back test, and then I'm gonna add in something. We're gonna try this. This is triple leverage SPY, GLD sim, and I think BND sim is a thing. Yes, it is. So let's try. Let's just see what the downside looks like when you diversify and triple leverage and you rebalance quarterly. Let's just see. I just want to say I actually haven't even looked. Portfolio 3, it doesn't have a name. Portfolio 3, so look at this. So your best bet was to invest with SPY. Oh, hold on, what are the parameters? I'm sorry. 1,000 a year cash flow, whatever, fine. That's what we'll do. So you start with 1,000. Every year you invest 1,000, right? You'll know SPY performs the best, right? In this negative decade, you actually return just a little bit of money. Barely. Barely. It says negative cumulative return. I'm not sure why it says that. Because it's a return of $500, isn't it? Whatever. What you'll notice is that straight up leverage, you still get crushed. But when you diversify and you balance out of it, you don't get hurt as much. This is such a downward spiral protector. Like it really protects you from these horrible months because maybe triple leverage SPY has a crazy quarter where you get like a 40% return. That's just not sustainable. You need a diversifier. Now, some people like managed futures. Some people like triple leveraged bonds instead of regular bonds. This is the one that makes me feel comfortable. The reason I'm going BND over ZROZ, the theory for that I always see is ZROZ, but I like BND because it's diversified between multiple countries. I am a little worried about the risk of being fully American by going SPY plus American bonds. So BND is a multi-country diversifier. It's one of the largest funds in the world in that it carries so many different bonds on it. And maybe I can even see that on the. Now America's still a huge part of it. They are the biggest um, seller of bonds, but overall, I just want to show you my diversification, why you really need to be diversified. And I want to show you a little bit about how we've been holding up during this negative market now. My stocks are a little confusing to watch, but year to date, you'll notice I'm definitely down a huge percent, like 8%. We'll just go 7.5, but 8% we'll call it. And if we go to, I'm just gonna go to my retirement, so that's 7.6. Go to retirement. What is SPY down, or VOO, its equivalent, is down 4%. So I'm trailing. Now I am investing in a lot of stuff. That's not just the triple leverage stuff, and that's gonna be cleaned up soon in just a couple months. But I'm trailing year to date, and I'm okay with that because, as you see, even during these lost decades, I'm expected to lose. But my goal is to get huge winners on the upside, and that's why I'll show you 2010 to 2020, a huge winner decade. On the upside, now notice the diversified portfolio, the rebalanced portfolio, trails the pure leverage portfolio on an upside trend. On an up decade, pure leverage wins. Hey, this is a little scary, sure, but you still win by a ton. But still notice that on an uptrend, the rebalance portfolio still beats SPY by quite a bit, by a huge percentage, by almost double, right? And now let me show you the bad and the good together. Bad decade, and we're lucky, it's such easy numbers, 2000 to 2020. And let me show you a bad decade and a good decade back to back. And now you really start to see the value of diversifying. Like, yes, triple leverage wins, right? Triple leverage wins. If you just go straight leverage, you do win over 20 years. Look at that. It outperforms by quite a bit, by 40%. Incredible. But the scary parts of investing look way less scary because remember, the yellow line is my portfolio, the blue line is the SPY. So I outperform, but with way less volatility. With way less. So overall, I do think this is going to be the winning strategy. I just wanted to share where I'm at. We're at April. Around May, maybe I'll show some more. I'll have sold these other positions. And this can be more of a pure case study. I'll probably keep the options open, but this is more of a speculative play. This is not part of my investment thesis. Um, Overall, it's going pretty well with the triple leverage. I'm liking it. I'm buying, and I'd love to show you another video, some of this, to show you where we're at. I'm kind of saving this for when I clean up my other positions, but looking good so far.